Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. S&P 500 right at about 60.37 for a level that's up about 2.8% year to date. Nice, about 3.5% gain over the last week of trading, really driven by some inflation news, along with probably a little bit today, some inauguration news as well. We'll get to that in a second. Before I mention that, I'll also just mention that the 10-year Treasury, interest rates on the 10-year Treasury have dropped from about 4.8% about a week ago down to about 4.6%, once again, kind of moderating downward based on that inflation data, which we will turn to now. So last week, we got a month-over-month inflation reading of about 0.2% in the core. So once again, that core inflation number, excluding energy and food prices, that is the one that the Fed really focuses on. And numbers that are 0.1 or 0.2% month over month is really what we're looking to see. It's not exactly the right math, but it's close enough. If you take that 0.2%, you multiply it by 12 months in a year, you would get to a 2.4% sort of annualized inflation rate, which is pretty close to the Fed's target of 2 to 2.5% inflation in any given year. Obviously, 0.1% would be a little bit better. That would get you to about a 1.2% inflation rate, but certainly moving in the direction that the Fed would like to see. And good because it's a little bit of a deceleration from the prior readings that we had seen in the core, which had all been about 0.3%. So nice to see that inflation number sort of moderating back downward. And this has given, I think, the market a little bit of hope, confidence, optimism, maybe, that the Fed may not have to leave rates where they are as long as people anticipate, that inflation is still continuing to moderate downwards, and that this, in turn, will mean that the Fed can maybe get back to their path of cutting rates sort of later this year, and certainly probably doesn't have to reverse course, at least based on the data we've seen. So that is lovely news coming last week that sort of drove market performance for much of the week. The second thing that I would just note is that it appears that we have at least temporarily dodged a little bit of a bullet on tariffs. Just to be clear, the market doesn't like tariffs. It doesn't like tariffs because it makes everything in the United States a little bit more expensive. That in turn passes on inflation through the rest of the economy, in which the Fed would then try and combat with higher rates for longer, which obviously the market doesn't like. And it's interesting because a lot of people sort of widely expected that during Trump's first day in office or first 2 days in office, he would just sort of impose sweeping tariffs across the board. That has not been the case, and indeed, I think he has indicated some willingness to wait a little bit of time before some of those tariff packages might go into place. And I think it's important to note for this administration, we have seen this before. They will threaten something as a negotiation tactic, and then maybe not implement it. So I think the market taking a little bit of hope that maybe we don't see widespread tariffs. Both of those two data points are a little bit backwards looking. I would note for folks that all eyes now are going to turn to earnings reports. About 50% of the S&P 500 will report earnings within the next 2 weeks. And so we will be looking at those companies to sort of give us an idea of how they finished up 2024, and more importantly, what are they seeing in sort of the early stages of 2025 and sort of consumer behavior, industrial behavior, et cetera. So it will be an exciting time over the next 2 weeks as we start to digest those earnings reports. With that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.